recession is more likely in 2024 than not. This is the Boom Bust Invest Earnings and Recession Risk update for November 2023, and in this video we're going to take a look at the base case of why I think recession is more likely in 2024. So each month I do a series of videos and I take a look at these main indicators to get a better idea where global stocks and bonds are heading. So if you head over to boombustinvest.com, you'll see the financial crash page where we're looking at all these various indicators. And if you go down to the earnings and recession section, you can sort of get the links here to what I'm going to sort of summarize over the next few minutes. You can go through that whenever you want, but I do these monthly videos, as I say, just to get this analysis out there, get any feedback. So please leave any comments on questions or suggestions. And so let's jump into these pages here. So first off, we've got FactSet, which is a global market data provider based in the US. So let's just see what they're saying here. So for the third quarter, S&P is reporting year-over-year earnings growth of 4.1%. However, the fourth quarter analysts are now projecting earnings of 3.2%. So it's declining. Do analysts believe that earnings growth rates will continue to decline sequentially in 2024? They think not. They say that the Q1 of 2024 predicting growth to 6.7 and Q2 10.5, and that the sectors leading that are going to be communication services, community discretionary, not staples, and information technology. So for some reason, FactSet think that this is all going to turn around in 2024 and everything is going to be fine. But from what I can see, I can't see exactly why they might be saying that. The Morgan Stanley research, so over at isabelnet.com, Morgan Stanley saying earnings revision breadth for both large and small caps has returned to negative territory, which means that the overall sentiment expectations for future earnings have worsened. And so you can see here the breadth, so there's more earnings revisions down than there are earnings revisions up, which is bearish. And if that continues, then we would expect problems with our global trackers going forward. The All Country World MSCI Index net revenue revisions. So this is a quarterly moving average of the number of forward earnings estimates, less number of estimates down. So we can see on a global basis, heading into negative territory for earnings revisions as well. So the big drawdowns here, you see Great Financial Crisis, 2008 and 2020 COVID. So on a quarterly basis, what we've got to really watch out for is when it gets down to below minus 10 here on this index. So we see a big quarterly drawdown below 10. That's when we know we're in sort of, that's if I were to see this, I would be personally allocating out of global equities and probably into global bonds. So heading over to the conference board then, update, latest press release. So these guys are very well respected and often quoted. They have this leading economic index, which takes a blend of leading economic indicators and combines it into this index to show where we might be heading. So this is for the US, but of course our global trackers are largely invested 60 to 70% in the US. So something that we need to keep an eye on, really. The LEI for the US fell again in September, marking a year and a half of consecutive monthly declines since April 2022. And although the 6-month growth rate in the LEI is somewhat less negative, and the recession signal did not sound, it still signals risk of economic weakness ahead. So far, the US economy has shown considerable resilience. Nonetheless, the conference board forecasts that this trend will not be sustained for much longer, and a shallow recession is likely in the first half of 2024. So, the conference board is predicting a recession as well. The annual growth rate of the LEI, so this is the year-on-year change, has been negative, indicating weaker economic activity ahead. And on a global, they have a global recession tracking page themselves here. So the global leading indicators signal slowing in global GDP growth. So you can see the LEI index here coming down in the Great Financial Crisis. This is a dot before the 1990 recession. So going way back is pretty accurate. You can see here the GDP is actually heading up, but they're saying that that's probably not going to continue. So that's another one that I'm going to be sort of taking a look at each month. The global economic outlook from the conference board. So again, they're saying global real GDP is forecast to grow slightly in 2023. We expect further slowing in 2024. Looking ahead, we expect relatively subdued economic growth. The growth forecast for 2024 are generally strongest in emerging and Asian economies, and weakest in Europe and the US. So heading back over to isabelnet.com and more on again from the conference board, consumer expectations. Gloomy confidence expectations have historically not been a positive sign for the US economy, which can lead to reduced spending and investment. So on the consumer side of things, you can see here their index of confidence expectations, consumer confidence expectations, is down at similar levels seen before the COVID crisis, and lower in fact than before the Great Financial Crisis, similar levels to the dot-com, just before the dot-com crash. So another indicator for slowing consumer spending and potentially pointed to recession in 2024. On micro, so if we look at the graph here, the global recession probability, you can see this must be back testing that they're doing here. When it gets above 50, this is when we've seen it looks quite accurate. When that we'll see a global recession. So I mean, it did briefly, but it's come back down here, so still relatively high. So putting this together, I would say the main indicator that I'm looking at here is actually sort of being in global index funds is the All Country World Index of Net Revisions. We can see here that the peak of the markets here in 2022, it was going up. When they start revising down, this was obviously when the market came off the peak and continued down in 2022 and 2023. When revisions started going up again, we saw a recovery in the markets. Now markets are still in recovery mode. However, if these quarterly revision earnings for the All Country World MSCI index continue down, then this would be if we see that, this would be the sort of main indicator that I'll be looking at to deallocate from global equities if we see something like this happening. Any questions or suggestions, please leave them in the comments, and I'll see you in the next video.